Welcome back to the Deep Dive. Today, we are going laser focused on HP Inc., that's HPQ, and their latest numbers. They just dropped their Q4 and full year 2025 results.
They did, right after the bell on November 25th. And if you were watching the after hours ticker, you saw it, just an immediate, violent reaction.
Yeah, a big drop, which is strange because on the surface, the quarter itself looked pretty solid.
It was solid. Operationally, they did well. But the story here, the thing that drove that 5-6% plunge, was all about the forward guidance, what's coming in fiscal 2026.
Okay, so our mission today is to cut through that noise. We're going to distill exactly what drove the good quarter and then what management said that just terrified the market.
Exactly. Why that huge gap between past performance and the future outlook is so critical right now.
All right, let's start with the quarter they just put in the books. Q4, they actually delivered their sixth straight quarter of revenue growth.
Yep, 6 in a row. Revenue came in at $14.6 billion. That's up 4.2% year over year. And, that top line number, it was basically right in line with what Wall Street expected. No surprises there.
And the bottom line, the earnings per share.
Modest beat, actually. Non-GAAP EPS landed at 93 cents. That was a penny or two better than consensus. And a little above the midpoint of their own guidance. So if you just isolate Q4.
Let's just look at the quarter in a vacuum.
In a vacuum, it looks great. Disciplined growth. The momentum was definitely real.
So a revenue streak continues, an EPS beat, and then the stock gets hammered. What was the absolute bombshell that caused investors to just dump the stock?
It was one thing. A massive external cost pressure that they said is coming.
Yeah.
And they didn't just warn about it, they quantified it. They put a number on it and baked it into a much, much lower forecast for next year.
Okay, so the message was basically, great quarter, but brace for impact.
That's it, exactly. We see a storm coming and we're dropping the anchor right now.
All right, before we get to the storm, let's talk about the engine that was working so well, personal systems.
Yeah.
The PC side of the business.
Absolutely. PS was the real highlight. Revenue there grew a very robust 8% year over year. Units were up 7%. But the key thing here isn't just selling more boxes. It's what they're selling.
The mix.
The mix. They're gaining share in the high-value spots, premium commercial PCs, those really high-end workstations for data science, and importantly, they're getting more subscription services attached to those sales.
And what about the big buzzword, AI PCs? Where are they in that transition?
Well, according to them, they're actually ahead of the curve. Management said AI-capable PCs were over 30% of their shipments in Q4.
30%. That's a pretty strong number already.
It's a very strong number. It shows they're really positioned to capture that big refresh cycle that's coming with Windows 11 and, the need for on-device AI.
Okay, so the PC engine is humming, but there's always a counterweight at HP, isn't there? The print segment? Any improvement there?
No, none. It's still a drag. Printing revenue is down 4%.
Still shrinking.
Still shrinking.
Yeah.
They pointed a weakness in supplies, commercial printing. You had double-digit declines in hardware units. The margins are still high, sure, but that top line is just signaling a structural weakness that isn't going away.
So print is a slow bleed. But the real fear, the thing that caught everyone off guard, was a problem inside that healthy PC engine.
This is the heart of it, right?
This is the absolute crux of it. This is what some analysts are calling the memory tax. Management spent a lot of time on the call explaining this sharp, unexpected spike in the cost of memory. DRAM, NAND flash, the stuff that goes into every single computer they make.
Okay, hang on. Explain that. The memory tax.
Yeah.
How much does that actually impact their bill of materials, the BOM?
It's huge, and they gave us the number. Memory now makes up between 15 and 18% of a typical PC's cost to build.
Wow, 15 to 18%. Yeah, so any increase there just directly eats their profit margin on every single unit. And the fascinating part is the root cause. This isn't just some normal cycle. It is directly tied to the global boom in AI infrastructure.
Help us connect those dots. How does, a giant data center being built in Ohio affect the cost of a memory chip in a laptop I'm buying?
Because global capacity for the really good stuff, high-end DRAM, HBM, it's finite. AI models need just colossal amounts of that memory. So you have the big cloud players, Google, Amazon, Microsoft.
Right.
They're spending billions, and in the process, they're basically vacuuming up all the world's high-end memory manufacturing capacity. That tightens the whole market and jacks up the price, even for the regular DDR memory that HP uses.
It's a massive capacity squeeze.
A massive sudden squeeze.
Yeah.
And it's hitting them hard.
And the timing on this is crucial. When does this margin pain actually show up in their results?
That's the key nuance.
Yeah.
They said they have some inventory protection, some long-term contracts. So that'll shield them for the first half of fiscal 2026.
Okay, so the first 6 months are okay.
For the most part. But they were very clear. These rising memory costs will hit and hit hard in the second half of FY26. So they've got a 6-month window, but the pain is already baked in for the back half of the year.
That gives them a little time to react. What are they planning to do about a, 15 to 18% cost hit on a core part of their best division?
They laid out a few aggressive strategies. First, just leveraging their sheer scale to negotiate better prices. Second, portfolio redesign.
What does that mean?
It means qualifying cheaper suppliers or even, reducing the amount of memory in certain models where they can get away with it. And third, and this is the big one for consumers, tactical pricing actions.
Price hikes.
Price hikes. Selective, they say, but across the board. So they're going to pass some of that cost on. And on top of all that, they mentioned new U.S. trade regulations are adding even more cost pressure.
Okay, speaking of aggressive action, they also announced this massive restructuring plan, and they tied it directly to AI.
Exactly. This is their long-term answer. It's a huge initiative. They're targeting about $1 billion in gross run rate cost savings by the end of fiscal 2028. The idea is to use AI to make everything they do more efficient.
Sounds great. But there's human cost, job cuts.
A major one. The plan involves cutting between 4,000 and 6,000 jobs. That's what, 7 to 10% of their entire workforce?
Wow.
Yeah. And it'll cost them about $650 million in charges to do it, with a big $250 million chunk hitting next year in FY26.
So it's a painful move. I mean, is it plausible that AI efficiency can really offset a structural commodity price hike like this? Or is this just, a convenient cover story for layoffs they needed to do anyway?
That is the multi-billion-dollar question, isn't it? Management is betting it's a former, but the market sees them cutting jobs now, save money later, while guiding EPS down now because of memory costs. It means the near-term story is just defined by pain.
Which brings us right to it, the guidance missed, the reason the stock sold off.
This is the hard reset. The midpoint of their full-year FY26 EPS guide is around $3.05.
And where was the street before the call?
The street was up around $3.40. So the new guide is roughly 10% below the consensus estimate.
A 10% guide down. After 6 straight quarters of growth, that feels more like a catastrophe than just being prudent.
The market definitely saw it as a shock. But what's so important is how specific they were. They told us exactly why. They baked in an estimated 30-cent impact just from the memory cost increases, net of all their mitigation plans.
30 cents. So that single headwind, the memory tax, that's basically the entire difference between where Wall Street was and where HP's new guidance is.
Almost the entire thing. It shows you just how powerful this inflation surge is for their bottom line. And they guided Q1 a little soft, too, in the range of 73 to 81 cents.
So, okay, we have clear pressure on earnings. But what does this mean for the cash story? Because cash flow is kind of HP's whole appeal for a lot of investors.
And this is where it gets really interesting. Because despite that big EPS hit, the cash story is, well, it's surprisingly strong.
How strong?
They're guiding for fiscal 26 free cash flow of $2.8 to $3.70 billion. That's roughly flat compared to this year.
Flat, even with earnings going down. How?
Better working capital management, tighter controls on spending, and just the timing of those restructuring costs. The cash engine itself is still running fine, even if the reported profit is getting squeezed.
And they're still committed to returning that cash to shareholders.
100% of it.
Yeah.
They reaffirmed that commitment, and then they proved it by raising the quarterly dividend to 30 cents a share.
So the profitability gets a dent, but the dividend, that floor, is actually rising.
Precisely. And they're banking on the market eventually seeing this as a cyclical commodity headwind, not a permanent failure in their ability to generate cash. They're betting on their long-term tailwinds to get them through it.
What are those big tailwinds they kept mentioning?
3 main things. First, the big Windows 11 refresh. There's still about 40% of commercial PCs running Windows 10, and that's a huge built-in driver. Second, just the continued acceleration of AI PCs. They think that could be 40 to 50% of shipments next year.
Wow.
And third, growing their recurring revenue. The subscriptions, the software, the services, that's already approaching $1 billion a year.
Okay, so let's put it all together. We have a stock that just dropped, trading around $24. The guidance missed by 10% because of what they claim are temporary costs. But they're still guiding to flat free cash flow and a higher dividend.
Right, and analysts are already starting to say it's cheap now with a double-digit free cash flow yield. So you have this profound clash. Is it cheap cash flow gold, Or is the EPS miss a warning sign of something worse?
This is not financial advice. But if we were to pitch a trade, an outrageous but plausible idea to play this exact divergence, what would it be?
I think we'd implement what we can call a long-term yield-focused conversion trade.
Okay, break that down.
We're playing the margin recovery story over, say, the next 18 months. But we want to do it without tying up a ton of capital, and we want to use that cash flow floor as our safety net.
So how do you structure that?
Okay, the main move is to go long on the recovery. You buy long-dated LD6 calls. Let's pick a strike. Say the $26 strike expiring 18 months from now. That's your pure bet that they execute the savings plan, the memory cycle turns, and the stock gets back above 26.
So you get that long-term upside exposure for a fraction of the cost of buying the stock. How do you fund it?
To help pay for that call premium, you exploit that dividend floor we talked about. You simultaneously sell near-dated, out-of-the-money puts, something like a $22 strike put that expires in 30 days.
I see. So you collect the cash, the premium, from selling that put. And you're basically betting that the strong free cash flow and dividend will keep the stock from crashing below its recent low, around $23.
Exactly. You use that premium to subsidize your long-term bullish bet. It limits your cash outlay, and it's a very focused wager. You're betting on their ability to execute that billion-dollar savings plan and that the FCF story will win out over the temporary EPS volatility.
That is a really fascinating way to play it. Okay, so to sum this all up, HP delivered a really solid Q4, sixth straight quarter of revenue growth, strong AI PC momentum.
It was completely overshadowed by an FY26 guide that was a full 10% below what anyone was expecting. And that miss was driven almost entirely by a 30-cent hit from the so-called memory tax.
Which then forced them to announce a huge restructuring, 4,000 to 6,000 job cuts aimed at saving $1 billion, all while they're reinforcing that cash floor with flat free cash flow and a dividend hike.
Right.
So the ultimate question for you, the investor, is this. Is that $1 billion AI savings plan actually enough to protect profits from inflation and the slow decline in print? Or is this memory tax just the first sign of a fundamental change in how profitable the PC business can be?
And that decision, is it a temporary cycle or a permanent structural problem? That is what you are paying or not paying for $24 a share.
A lot to think about. We encourage you to continue analyzing the underlying data the company released.